Welcome to Hong Kong, Asia's world city and a unique cultural melting pot where East meets West. As a financial powerhouse and the world's gateway to China, Hong Kong is a major destination for international corporates, and much has been written about the city's lack of space and its sky-high prices for the commercial real estate. In a major new research report, CBRE and Daiwa capital markets have identified exactly how much space the city will need to maintain its economic growth by 2020, also crucially pinpointing sites where new office supply could realistically be brought to market. I met first of all with James McLean from CBRE to get a better understanding of Hong Kong's office market today and some of the key challenges faced by occupiers.
So when an occupier is looking at where they might want to be located within Hong Kong, they're very much looking at the industry that they are within. Generally, the financial sector would prefer to be located in central. It's where their customers are. It's the right image for those kind of occupiers. Trading companies or retail sourcing companies, perhaps historically, and therefore the trend has continued, would be located on the Kowloon side. Insurance companies over the last few years, we've seen a significant trend of those large space users in that insurance sector move from the island over to the Kowloon side. That is predominantly driven by real estate supply of big office space, of good quality, and cost-saving opportunities.
So what are the key challenges in real terms for the market today?
So from an occupier perspective, one of the challenges that occupiers face are cost and availability of space. So effectively the market goes upwards and downwards very quickly, which in turn makes it a challenge for occupiers to plan their business.
So with Grade A office supply being tight in today's market, I caught up with Johntherington from Daiwa Capital Markets to get his views on Hong Kong's GDP growth going forward and what this will mean for office space demand in the longer term.
Our economists have analysed the relationship between business services GDP growth and office demand over the last couple of decades, and they found there's actually been quite a strong relationship between the two. And sort of extrapolating for that over the next decade or so, it seems to us that by the end of 2020 there'll be a need for about 17 million extra square feet of extra supply to accommodate that demand. What is the Hong Kong image in a decade's time? Is it going to stay, China's major entrepot, a world city? And we've assumed yes. And what is the kind of growth rate that would be necessary to sustain that? So at the core GDP level, we think a rate of 3.5% seems reasonable. It is slower than what has been achieved over the last decade or two, but then again, the economy is coming off a higher base. More importantly, when you look at the office sector, business services growth, which has been a leader of the economy for the last couple of decades, we see that growing at a 4% compound rate on average over the next decade, which again is the desired rate for Hong Kong to maintain its status as a leading world city.
Meeting Craig Shute, CBRE's Senior Managing Director for Hong Kong, Macau and Taiwan, I asked him, given the projected demand in Hong Kong, how much office supply would actually be coming to market by 2020?
We have a real shortage on the supply side. Our research shows that we need some 17 million square feet of space to be produced throughout this decade. However, we've only been able to identify about 8 million square feet that's ready to be developed. So there will be a shortage of about 9 million square feet of space which is required, which creates some real issues.
Hong Kong is short of Grade A space, and this shortfall will only intensify going forward. In their 2020 office report, CBRE and Daiwa experts have put forward solutions to help alleviate the supply problem. So Ed, where is the shortfall supply of space that could be found in such a tightly packed city?
The 9 million square feet shortfall that CBRE has identified is best looked at in separate parts. First of all, we've got private developments. Now, this accounts for about 3 million square feet. And one would imagine that given the anticipated lack of supply feeding through to the market, the current low vacancy that exists, that developers would be very keen to bring these projects to market and therefore get them out onto the market before the end of the decade. Of the remaining 6 million square feet, all of which it relates to government sites, 3 million square feet is to be located beside ICC in West Kowloon, in the West Kowloon Cultural District, and also above the future high-speed train terminus. That leaves us with 3 million square feet to be found. And for this, we look to Kowloon East and to the CBD2 project. CBRE has identified the individual sites that before the end of the decade could give 3 million square feet of future supply. While the CBD2 project is a very large project, it will take a very long time to complete, we are confident that these sites can be fast-tracked.
So we're talking about a lot of space, but what are the cost implications for this?
The 7 government sites that we've identified with about 6 million square feet that we think need to be brought forward for development or for sale and development in this decade are going to be very expensive to develop. The land alone should amount, or we estimate will amount to about $37 billion just to purchase, and that's an important number because that's what the private sector developers are going to have to come up with up front in land auction costs. In addition, there's about $23 billion in development and financing costs. So you're talking about $60 billion in total. A lot of that's taken up by one site alone, which is the West Kowloon terminus that's being built for the endpoint for the high-speed rail that'll go to Guangzhou. The land cost on that alone, we estimated about $17 billion, in development costs of about $9, so $26 billion in total.
So how would you summarise the challenges that Hong Kong is going to face over the next decade?
Hong Kong is facing issues like a number of cities face issues. The good thing about Hong Kong is we've got supply constraints. It's not on the demand side. We have a number of occupiers that are coming to us to expand their businesses, to grow, to move location. The issue is that they don't have the options. And what our report has identified is that some solutions. It's a can-do list, not a wish list. What we need is that for private developers and government to come together and to really get this development moving. What we need is action now. These buildings take a long time to actually come to fruition and to come online, and we need them to really be started now. Otherwise, Hong Kong's prosperity over the next decade is certainly going to be affected.
That's it from me. For the full report, please go to CBRE or Daiwa's website.